I'm Jim Scheinberg, Managing Partner and Chief Investment Officer at North Pier Fiduciary Management in Los Angeles, California. It's April 30th, and I'm here to give you the spring edition of our Economic and Market PIERspective. Today we're going to review the first quarter, give you updates that have happened since the quarter's close, and provide our forecast for what we expect to come. Nearly 5.5 years ago, the market peaked in October of 2007. And in the first quarter of this year, we finally surpassed those numbers. One could feel the mood on Wall Street start to change as the media and pundits essentially started to echo a more optimistic viewpoint towards the future. Unfortunately, similar to many periods of time of optimism in the past, we did see some gray clouds start to roll in as some mediocre economic reports started to lace the news headlines in March. This is likely due to the beginning of sequestration. Sequestration, of course, is the unfolding of the mandatory substantial budget cuts at the federal government level that were required out of the wake of the fiscal cliff that came into play in the fourth quarter. Since Congress was not able to make a bilateral partisan agreement for the budget, massive budget cuts did come in and sparked concerns that that would have a meaningful impact on the U.S. economy. Whether this pause was more perception-based, as people were taking a wait-and-see approach, or if it was actually borne out in true economic data, remains to be seen. One thing is certain, that for the time being, the economic acceleration that we had begun to enjoy in the fourth quarter of last year that carried through Q1 of 2013 seems to be on hold. In the first quarter of 2013, fixed income markets were mixed. As the economy strengthened, U.S. Treasuries saw a rise in yields, with the 10-year bellwether rising from 1.75% at the beginning of the year all the way up to 2.05% intra-quarter, only to fall off as the economy started to slow down as we came into the end of March. The 10-year Treasury ended up at 1.85%, which caused a slight decline in the value of most U.S. government bonds. We also saw a decline in the international fixed income market, both in the developed markets as well as the emerging markets, both seeing declines somewhere in the neighborhood of approximately 2 percentage points. That was exacerbated by a rise in the US dollar of about 4% that really took positive returns in those markets and made them negative in net terms when looked at in the US dollar. The only real high note was high-yield bonds in the United States have continued their torrid pace and posted nearly 3% returns again as credit spreads managed to narrow one more time. Optimism in the economy obviously leads to lower default rates, and those high-yield bonds are the most sensitive to that environment. In the equity markets, robust performance in the U.S. markets. As a matter of fact, it was one of the best first quarters on the history VIX. We had gains in the S&P 500 nearly 11%. Small caps did about 2 percentage points, even better than that. An interesting thing happened. The value side of the coin in large caps, which is largely related to healthcare and financials, outperformed their growth brethren, which was really weighed down by the technology sector. Interestingly, on the small cap side, the relationship was exactly reversed. Small cap growth stocks, which are more nimble and niche oriented, outperformed their small cap value brethren by about 2 percentage points. The international markets did not fare as well. As in fact, this was exacerbated, as we mentioned before, in the rally in the US dollar, which created lower performance in those developed markets when put back into dollar terms, but also those markets saw their rallies run out of steam right around February and actually saw reversals in the emerging markets. Emerging markets finished the quarter down after a really robust performance in January. We expect that this trend may actually continue. The U.S. stock market is anticipated from North Pier's perspective to outperform these international markets, at least in the near term. Moving over to the equity markets, only the United States was able to maintain the robust performance of Q4's rally into all of Q1. The S&P 500 saw gains in excess of 10%, and small cap stocks actually outperformed that by another 2%. In the large cap domestic space, value led growth by about 2 full percentage points as well, as cyclically sensitive names outpaced their growth components. As a matter of fact, The growth side of the ledger was highly weighted down by poor performance in technology, which is normally thought to be a little more robust in economic recovery. Once we go back over to the international markets, again, as we mentioned, the rally in the US dollar hurt performance for international stocks when you backed it back out into US dollar terms. Europe saw gains in the lower to mid single digits, and emerging markets actually ended up seeing net losses as their January gains were completely wiped out in February and March. This was largely contributed to sluggish economic performance in Europe, as well as exacerbated by the drop in commodity prices worldwide that we've begun to see. Of course, emerging markets are much more sensitive to these natural resource prices, and of course their companies' economies, as well as the companies in them, is sensitive to their declines. Since we founded North Pier in 2008, we've been commenting about the race of the recovery on a quarterly basis. Our primary indicator and the most reliable predictor of the economic pace has actually been the Institute of Supply Management's report on business, both on the manufacturing and the services side. We have constantly looked to this data indicator first to give us confidence or concern as to the unfoldings of the pace of the recovery. And it has been incredibly accurate. As a matter of fact, it gave us a great deal of confidence while others were getting dubious about the economy even being able to maintain its recovery, let alone the pace of it, back during a couple of flinch moments back in 2010 and 2011. As we mounted through the first quarter, we saw that, in fact, these indicators did show robust advancement through January and February. But as the sequester started to unfold into March, we did see the reports show that, once again, purchasing managers are showing concern and taking pause before they get aggressive in spending, both again on the services and manufacturing side. We are still showing advancement, but at a slower pace. At this point in time, North Pier remains confident, but we are watching this indicator very closely to see if there is any further contraction. We suspect that, once again, it is just a momentary flinch. Consistent with the pattern that we saw in the business-to-business arena, consumers also followed suit with a temporary drop in sentiment in March as the sequester rolled past the headlines. Unlike the ISM, at this point, we do have a glimpse at April's readings, though, which showed a recovery. In fact, consumer sentiment is now at the highest levels that we've seen since the beginning of the crisis. And we are now at the cusp of potentially breaking into what used to be considered to be normal sentiment levels. If confidence continues in the business side, as well as housing and in jobs, we could see consumers turn positive for the first time in over 5 years. So let's take a look at jobs. Well, we're seeing a similar pattern there that we're seeing in the sentiment numbers from the consumers and the business purchasing managers. We saw robust advancements in January and February, but unfortunately a little slowdown as we got into March with only 88,000 jobs created. Now, this makes sense, again, if organizations who are dealing with the federal government or reliant on those contracts took pause before making new hires to see the way the sequester managed to unfold. But in fact, there was a silver lining in the jobs data. As frequently as overlooked, we like to look at the revision statistics from prior months. And in fact, there were nearly 30,000 jobs created that were underreported in January and February that were brought into the March report. So when adding that 60,000 to the 88 that had previously been reported, 150,000 jobs were newly found and created in that March report, which is a number that is much more acceptable. Whether or not we see a trend in declines in new jobs created going forward, or whether this turns to be, again, a momentary flinch remains to be seen. But we at North Pier think that it's probably more than flinch. My optimism on jobs, business, the economy, and markets in general continues to hinge on real estate. We've stated this for years now. You can't get out of the crisis, and you can't get out of the mentality of the crisis unless the thing that puts you in there is in full recovery, and that is the real estate market. Well, there the news is all good, including March's data. Both existing and new home sales are showing that purchasing is accelerating in practically every major market. This is leading to price increases across the board. The all-important Case-Shiller Index of 20 major markets has shown a 9.3% increase in the average home price nationally in just 1 year. Right now, inventories, because there is so much activity and so few homes on the market, have declined to such a level that there's only a 4.7 month supply of homes on the market. That is well below norm, let alone a housing crisis period. In fact, we're down from 6.2 months of supply just a year ago and over 12 months of supply at the worst levels post-crisis. If this tightness continues, and we think that it will, further price gains are almost absolutely assured. In fact, we are now at such tight supply levels that we're rivaling the tightness of supply that we saw in 2005 before markets went elliptical. I continue to maintain that our primary theme is that the mounting recovery in U.S. real estate is the foundation of the recovery of the global economy as a whole. In the near term, foreign markets may continue to see improvements in a fits and starts type of pace, similar to that which we've seen in the United States over the last few years. However, it is the steady and continued improvement in the aforementioned areas of U.S. labor, consumer spending and sentiment, and business-to-business activity, coupled with our strengthening real estate market, which is the support of our growing contribution to the global recovery. As long as real estate remains strong here at home, and we believe that there is ample evidence that it will, stumbles and pauses, both here and abroad, should be very short-lived. Before long, global momentum should build, thus creating further fuel for our own recovery and advancement here in the United States. If I was to give a weather forecast to show you what we thought the current and forward-looking conditions look like, I would say that the old analogy of April showers bring May flowers is not far from the point. The clouds that we've seen here in March and April should give way to sunny skies as the summer unfolds. But we'll see if the momentary blips that we've seen in some of our indicators either build or fade away like the little glitches that we believe that they are. So, my name is Jim Scheinberg. I am the managing partner of North Pier Fiduciary Management, and I invite you to check back with us over the summer to see what our perspective is on the economy and the markets at that time.